Hello students, welcome to today's episode. In the first part of the risk analysis and capital budgeted, we have discussed non-mathematical methods of incorporating risk in capital budgeting. Today we will discuss about mathematical or statistical techniques. I am Dr. Arshia Hussain, PhD in Human Resource Management and teaching in the Department of Commerce and Business Studies, Jamia Millia Islamia, New Delhi. So, we will start with the mathematical or statistical methods of risk in capital budgeting. Mathematical methods, also known as statistical techniques, has the following methods under its heading. The first one is probability distribution approach, that is PD. Second one is decision tree approach, that is DT. And the third one is simulation approach, probability distribution. Risk is the variability of possible outcomes from expected return. The standard deviation as a measure of risk provides information about the probability distribution of possible outcomes. Now we will see the advantages of probability distribution method. First advantage is it does not result in compounding of risk over time. Second one, it helps in determining the probability of a project, that whether it provides a net present value of less than or more than the specified amount. The third advantage is it provides a quantifiable measure of risk, that is standard deviation. The fourth advantage is after calculating a standard deviation, which is an absolute term, coefficient of variation can be calculated and can be compared with the projects of heterogeneous size, since coefficient of variation is a relative term. Coefficient of variation may be calculated as follows: standard deviation, coefficient of variation which is equal to standard deviation divided by expected net present value multiplied by 100. In probability distribution approach, probabilities can be determined for each year separately. This helps in more precise determination of probability distribution. Now we will see demerits of probability distribution method. The first demerit is the use of probability distribution method involves a lot of estimation, since probabilities for cash flows are estimated for each year. The second limitation is the information may be biased. Since the data is subject to mathematical calculation, the cash flows can be intentionally underestimated or overestimated by the managers. The third limitation is it involves a lot of tedious calculation. Fourth one is sometimes other behavioral problems may creep in probability distribution and may distort it. The concept of probability is essential to the use of the risk analysis techniques. It may be defined as the likelihood of occurrence of an event. If an event is certain to occur, the probability of its occurrence is 1. But if an event is certain not to occur, the probability of its occurrence is 0. Thus, probability of all events to occur lies between 0 and 1. Probability distribution can be used to compute expected values. For this purpose, following procedure is adopted. Step 1, establish probability distribution. Step 2, multiply values with probability of each outcome. Step 3, aggregate the result of step 2. Now, we will see one illustration on this. Beta Limited is considering to start a new project for which it has gathered the following data. We are given the data in the form of the table: cash flow and probabilities. Cash flow 30,000, 60,000, 1,20,000, 1,50,000. The probabilities given are 0.1, 0.4, 0.4, 0.1. We have to calculate the expected cash flow. Now, we will see the solution. Cash flow probability, expected cash flow given to us as 3000, 0.1 is the probability, 300 is the expected cash flow. Then 6000 is the cash flow, probability is 0.4, expected cash flow is 2400. Then we are given 1,20,000 as the cash flow. The probabilities given is 0.4. The expected cash flow is equal to 4,800. Then we are given with the 1,50,000 cash flow. The probability given is 0.1. The expected cash flow given to us will be 1,500. So, the total cash flows will be equal to 9,000. We will see another illustration. Modern Company Limited is considering an investment in a project that requires an initial investment of rupees 50 lakhs with an expected cash flow after tax over 3 years as follows. For the first year, the cash flow after tax, that is CFAT, and the probabilities are given as 10, 0.4, 20, 0.3, 30, 0.2, 40, 0.1. Now, these cash flows are given in thousands. For the year 2, cash flow after tax and the probability given are 15, 0.3, 25, 0.4, 35, 0.2, then 45, and probability is 0.1. For year 3, the cash flow after tax and the probability is given as 20, 0.2, 30, 0.3, 40, 0.4, 50, 0.1. Now, these cash flow after tax are given in lakhs. Now, what we are required to calculate is, number 1, what is the expected net present value of this project. Assuming the cash flows are independent, firm's cost of capital is 10% and the firm can invest in 5% treasury bills. Second one, compute a standard deviation about the expected value. Third one is compute the coefficient of variation about the expected value. Fourth one is assume probability distribution is normal. Find the probability that A, NPV being 0 or less, B, NPV being greater than 0, C, NPV being at least equal to mean, fourth, NPV being 10% below mean, E, NPV being 10% above mean, F, NPV between 20 lakhs to 30 lakhs. Then G, the project is being accepted if the firm has the policy of accepting a project having net present value of rupees 20 lakhs. Then the project is being accepted if the firm has a policy of accepting a project having NPV of rupees 20 lakhs with at least 80% probability. I, the project is being accepted if the firm has the policy of accepting a project having net present value of rupees 20 lakhs with at least 50% probability. Now, we will see the solution. The first one, calculation of expected net present value. The expected cash flow after tax for year 1 given in lakhs and the probabilities given, and then CFAT multiplied by P, that is cash flow after tax multiplied by the probability. So, cash flow after tax is 10, probability is 0.4, then the product of the two will be 4, then the expected cash flow after tax for the year 1 is 20, probability 0.3, then the product is 6, then next it is 30, probability 0.2, the product of CFAT into P is equal to 6, then next is 40, probability is 0.1, then CFAT into P will be equal to 4. Similarly, expected cash flow after tax for year 2 in lakhs are given as CFAT 15, probability 0.3, the product will be 4.50, then 25, probability 0.4, then CFAT into P will be equal to 10, CFAT 35, then probability 0.2, then CFAT into P will be equal to 7. Then the last one is 45 CFAT. CFAT means the expected cash flow after tax, then probability is 0.1, then we get 4.50 as CFAT into P. Now, the total expected cash flow after tax for year 2 is equal to 26, and the total expected cash flow after tax for year 1 is equal to 20. Similarly, we have another column of expected cash flow after tax for year 3. For year 3, you can see CFAT, probabilities and the product of CFAT into P as given 20, 0.2 and 4. Then 30, 0.3 which is equal to 9. 40, 0.4, that is CFAT multiplied by P will be equal to 16. Then 50, 0.1 will be equal to 5, that is the product of CFAT multiplied by probability will be equal to 5. So, the expected cash flow after tax for year 3 will be equal to 34. Now, we will have expected net present value. For expected net present values, years are given to us, expected cash flow after tax, then present value at 5% and then the total present value. We can see in the table the years given to us 0, 1, 2, 3. Expected cash flow given to us as minus 50, 20, 26, then present value at 5% for year 0, 1, 2, 3. Is given to us as 1, 0.952, 0.907 and 0.864 for the third year. Now, the present value will be calculated as for the 0 year it is minus 50,000, for the first year it is 19.040, for the second year it is 23.582 and for the third year it is 29.376. So, thus the total expected net present value will be equal to 21,998. Now, second we will find out calculation of standard deviation for each year. We are given with variance of cash flow after tax of year 1 as follows. The table shows the cash flow after tax, that is taken as A, then cash flow after tax minus expected cash flow after tax, we will consider it as B, then C is equal to B square, then probability which is taken as D, then E is equal to C multiplied by D. Now, cash flow after tax given to us as, these figures are given in lakhs. So, that is 10 lakhs, 20 lakhs, 30 lakhs, 40 lakhs. Then column B is minus 10, 0, 10, 20. Third column C is equal to B square which is equal to For the first one 100, then 0, then 100, then again it is 400. Then probability for various cash flows after tax given as 0.4, 0.3, 0.2, 0.1. Then the column E is equal to C multiplied by D will be equal to 40, then 0, then 20, then 40. Now 100 is the total variance of cash flow after tax of year 1. Next is variance of cash flow after tax of year 2. Same way we are given with 5 columns. The first column A, which represents CF80, column B represents CF80 minus expected cash flow after tax. Then third column C is equal to B square, then fourth one is probability, and the fifth column is E is equal to C multiplied by D. Column A shows 15, 25, 35, 45. Column B has minus 11, 1, 9, 19. Column 3, that is C is equal to B square, is equal to 121, 1, 81, 361. Then probability given for various cash flow after tax is 0.3, then 0.4, 0.2, 0.1. The last column E is equal to 36.30, 0.40, 16.20, 36.10, and then the total variance of cash flow after tax of year 2 is 89. Similarly, variance of cash flow after tax of year 3. 5 columns given to us, column number A, column number B, then C, then D, and then E. In column number A, we have 20 lakhs, 30 lakhs, 40 lakhs, 50 lakhs. Column B, which represents cash flow after tax minus expected cash flow after tax, is equal to minus 14, minus 4, 6 and 16. Then column number 3, C is equal to B square, that is 196, 16, 36 and 256, which is our D column. The first figure is 0.2, then 0.3, then 0.4 and then 0.1. The fifth column is E column, which is equal to C multiplied by D. The first figure is 39.20, 4.80, 14.40, 25.60, and then the total variance of cash flow after tax of year 3 is 84. Now, calculation of a standard deviation about expected value. This is given in lakhs. Years given to us, variance, then present value factor at 5%, whole square, and then the last column of the product, which is equal to D is equal to B multiplied by C. So, for the first one, that is 0 year, there is nothing, no variance, that is 0. Present value factor at 5% is 196 and the product is also 0 because it is B multiplied by C, that is 0 multiplied by 196 will be equal to 0. For the first year, minus 100, then present value factor 16, the product is 90.700. Then for the second year, it is 89, present value factor, that is PVF at 5% is 36 and the product is 73.247. The third year, the variance is 84, present value factor 256 and the product is equal to 62.664. So, the variance about expected value is equal to 226.611. The standard deviation about expected value is equal to under root of variance. The third one is decision tree. Decision tree is a tool which helps to choose between several courses of action. It provides a highly effective structure within which options can be laid out and the possible outcomes of choosing those options can be investigated. It also helps to form a balanced picture of the risks and rewards associated with each possible course of action. It is a graphic representation of the sequence of action event combinations available to the decision maker. It depicts in a systematic manner all possible sequences of decisions and consequences. Each alternative course of action is represented by a branch, which leads to subsidiary branches for further courses of action or possible events. Decision trees are designed to illustrate the full range of alternatives and events that can occur under all envisaged conditions. Decision tree brings out logical analysis of a problem and enables a complete strategy to be drawn up to cover all eventualities before a firm becomes committed to a scheme. Decision tree technique is a method to evaluate risky proposals. A decision tree shows the sequential outcome of a risky decision. The decision tree approach gets its name because of resemblance with tree having number of branches. A capital budgeting decision tree shows the cash flows and net present value of the project under different possible circumstances. First of all, we will discuss the advantages of decision tree approach. The first advantage is it is useful technique in sequential decision making. Second one is it helps in visualizing the different alternatives in more explicit form in a graphical presentation. The third one is it provides a lot of information to decision maker in easily understandable form. Now we will see disadvantages of decision tree approach. The first disadvantage is lot of information is required since project is broken down into several stages and outcome is discreted. Second disadvantage is it becomes very complicated if number of stages to be incorporated become too much. The third disadvantage is sometimes it may not be possible to incorporate too many independent variables. For example, sales value depends upon market share, which in turn depends upon advertising, goodwill, sales promotion, expenses, etc. Now we will see one illustration on this. Star Enterprises Limited is considering two mutually exclusive projects A and B. Project A cost rupees 40,000 and project B cost rupees 50,000. We are given with the net present value probability distribution for each project. Project A and project B. So, in two columns we are given the net present value estimates for project A and then the net present value estimates for project B. Let us see this table. NPV estimates probability for project A, then NPV estimates and probability for project B. So, we are given with 10,000, 20,000, 30,000, 40,000 the NPV estimates for different years. The probability given to us as 0.2, 0.3, 0.3, 0.2. Then again for project B, the estimates are 10,000, 20,000, 30,000, 40,000. The probabilities are 0.1, 0.4, 0.4, 0.1. We are required to compute the expected net present values of projects A and B. Second, we are required to compute the risk attached to each project, that is the standard deviation of each probability distribution. Then you are required to compute the profitability index of each project. The number 4, which project do you recommend? State with reasons. Now we can see the solution. For the first one, calculation of expected NPV, that is net present value of project A and project B. This is given in thousands for project A. NPV given to us as 10, 20, 30, 40. The probability is given to us as 0.2, 0.3, 0.3, 0.2. Then NPV multiplied by P is equal to 2698. Similarly, for project B is also given in the same way, net present value 10, 20, 30, 40. Probability is given as 0.1, 0.4, 0.4, 0.1. Then NPV multiplied by P is equal to 1, 8, 12, 4. So, expected NPV is 25 for project A, and for project B the expected NPV is 25. Now, we have to calculate the standard deviation of project A and project B. Project A, NPV given to us, probability, then we will be finding net present value divided by 2 multiplied by P, then NPV multiplied by 2 multiplied by P. The figures given are for NPV 10, 20, 30, 40. Probability 0.2, 0.3, 0.3, 0.2. NPV divided by 2 multiplied by P, which is equal to 100, 400, 900, 1600. Thus, NPV square multiplied by P, 20, 120, 270, 320. Similarly, for project B, NPV 10, 20, 30, 40. Then probabilities 0.1, 0.4, 0.4, 0.1. Then NPV divided by 2 multiplied by P is equal to 100, 400, 900, 1600. Then the last column NPV divided by 2 multiplied by P, which is equal to 10, 160, 360, 160. The total NPVs is equal to 730 minus expected NPV square is equal to 625. Variance of NPV project A is 105, then standard deviation is equal to 10.247. Now, for project B, total net present value is equal to 690, then less expected NPV the whole square minus 625. The variance of NPV of project A is 65 and standard deviation is 8.062. The last technique or method is simulation technique or method. Now, according to T.H. Taylor, simulation is a numerical technique for conducting experiments on a digital computer, which involves certain types of mathematical and logical relationships necessary to describe the behavior and structure of a complex real world system over extended period of time. Simulation is a quantitative technique that utilizes a computerized mathematical model in order to represent actual decision making under conditions of uncertainty for evaluating alternative courses of action based upon facts and assumptions. Simulation enables to study the effects of certain informational, organizational and environmental changes on the operation of a system by making alterations in the model of the system and by observing the effects of these alterations on the system's behavior. A detailed observation of the system may lead to a better understanding of the system and the suggestions for improving it, which otherwise would be unobtainable. There are several techniques of simulation that are in use. However, Monte Carlo method is very popular as it is very simple and easy to use. The technique uses random numbers and is used to solve problems which involves conditions of uncertainty. It is a method of simulation by sampling technique. It employs random numbers and is used to solve problems that depend upon probabilities. It is applicable where physical experimentation and the creation of a mathematical formula is impossible. In simulation, a computer would normally be used to build and run the model. This is particularly important in this area, since meaningful information can be extracted from the simulation only after a number of runs with different random numbers. Now, we will see merits of simulation approach. The first merit is it is a straightforward and flexible technique. Second one is it can be used to investigate the behavior of problems which are too complex to be modeled mathematically. The third one is it can be used when the variables in the problem, for example, arrival time, service time, do not follow the standard distributions required for the mathematical models, that is Poisson distribution, normal exponential distribution. Fourth one is constructing the model inevitably must involve management. and this may enable a deeper insight to be obtained into a problem. Fifth one is, once a model has been constructed, it may be used over and over to analyze all kinds of situations. Sixth one is, risk involved in experimenting with real problems can be eliminated. Seventh one is, simulation does not interfere with the real world system but only with table model, and therefore it results in saving of cost. Simulation is cheaper and less risky than altering the real system. Eighth one is, time will be saved in simulation. For example, the effects of ordering, advertising or other policies over many months or years can be obtained by computer simulation in a short time. Ninth one, the simulation allows us to study the interactive effect of individual components or variables in order to determine which are important. Now we will see what are the limitations of simulation. First limitation is, simulation is not an optimization technique. It simply allows us to select the best of the alternative systems examined. There is always the possibility that the optimum policy is not selected. Second one is, reliable results are possible only if the simulation is continued for a long period. Third one is, a computer is essential to cope with the amount of calculation in simulation modeling. Fourth one, practical simulation inevitably involves the use of computers, which may be handicapped to firms without computer facilities or ready access to a computer. Fifth one is, to develop a simulation model means consumption of voluminous data, and it may be very costly. Sixth one, the simulation model does not produce answers by itself. Managers must generate all of the conditions and constraints for solutions they want to examine. Seventh one is, simulation methods generally are not as efficient as the analytical methods. Next is, a simulation model does not produce answers by itself. Next, not all situations can be evaluated using simulation. Next is, some models require a substantial amount of managerial and technical time. Now we will see one illustration on simulation. Sigma Limited is considering a proposal for the installation of a new machinery so as to expand capacity of production and also to reduce labor cost. The new equipment is expected to raise the level of profits for at least 5 years. However, due to uncertainty in the expected demand for the product, the cash flows cannot be accurately estimated. After conducting rigorous analysis, the finance manager has arrived at the following probabilities. The new equipment is having a cost of rupees 50,000. The appropriate discount rate is 12%. Analyze the risk inherent in the proposal by using Monte Carlo simulation by simulating NPV 5 times using the given sets of random numbers and find out the expected NPV and probability that NPV will be less than 0. Now, the average NPV is equal to rupees 7,050 plus 6,675 plus 9,855 plus 21,290 plus 18,785 divided by 5, which gives us the result of rupees 63,655 divided by 5, which is equal to rupees 12,731. So, for NPV less than 0, there is no chance, since NPV is greater than 0. So, that is all for today. Hope you have understood. We will meet in the next episode. Till then, take care. Goodbye.